Hi, everyone. I hope you're having a wonderful week. So, as you know, Playing the Unicorns really started to share everything I wish I knew when I was starting out as an entrepreneur 20 years ago. And we cover a wide range of things, everything from like the practical, how to raise money, how to come up with the ideas, to interviewing extraordinary entrepreneurs about their journey and the ups and downs and everything they've learned along the way. And this week we were very privileged to have the CEO of Slice who's going to join us. And the reason I'm really excited is that in a way Slice is the culmination of a lot of the thesis and a lot of the ideas we've been sharing over the last many months. It's a personal project of someone who really loves and knows a lot about the category. It's a vertical of an otherwise horizontal marketplace concept, the Uber Eats. It's a verticalization of Uber Eats, but it also covers a lot of the thesis I've shared on the future of work, of allowing people to do only the job they love as opposed to having to do many, many different things, which many small business owners are struggling with. And it's also a perspective where it covers a big chunk of my vision on the future of food and why more and more of the food will be ordered online and all the things that are entailed from it. So all that to say, I'm excited that we're going to have him this week, and I think the conversation is going to be super fun. So let's get started. Welcome to episode 24, How Slice is Allowing Mom and Pop Pizzerias to Compete with Dominos. So, Lear, thank you for joining us today.
Fabrice, thank you so much for having me. I'm excited to chat, as always.
This is super fun. I mean, look, I've mentioned it multiple times that I think Slice is one of my favorite investments. You're one of my favorite people. I think this is going to be a probably the next unicorn in my portfolio and possibly a decacorn in the coming years. So I'm very, very excited.
Yeah, of course. I appreciate your support as usual. You and I have some great conversations, and looking forward to building a $10 billion plus company. I definitely believe that's a very real possibility, and that's what we're working hard towards. But we'll jump into some of those details, I'm sure, during the conversation today.
Exactly. I mean, why don't we start with from the beginning, like a little bit of your background and how that background led into the idea of what Slice is and what Slice has become.
Yeah, my background is in really two main areas. One is technology. I fell in love with technology growing up. My older brother had a computer that we were not allowed to use, and that always means that time to use it. Fascinated by what was possible, so ended up getting a computer science degree and actually launched the tech support business out of school, which I franchised. More on that in a little bit. And then I also come from 3 generations of small business owners in the pizzeria industry. I have over 30 family members that own pizza shops, mostly in the Northeast. And when I launched Slice, it was merging these two areas of passion for me and bringing them together to ultimately, what I believe, build a generational business.
And when did you launch Slice, and what was the original idea of Slice?
Yeah, this is year 11 for me. So I launched Slice originally in 2010. We were operating under the brand mypizza.com. It was web-based. We were mostly focused on B2B website development and online ordering solutions for pizza restaurants. I bootstrapped the company for 6 years, picked my head up in 2015. We did 40 million in GMV as a bootstrap business with a very small team. And so between 2016 and today is when we started to bring on some investments, some amazing people around the room, including yourself and your team. And we've scaled quickly since then. So fast forward to today, we work with about 16,000 predominantly independent pizza restaurants nationwide. We will do over $1 billion in GMV this year, over 100 million in revenue, growing very quickly. And so that's been somewhat the journey, but there's a lot of other information coming.
Well, let's unravel a lot of that. I mean, So the beginning is really selling basically website development, like creating websites for pizzerias and in a bootstrap way, given that's kind of was your expertise, if I'm not mistaken. What, did you think it was going to be a big business? Did you envision it being something more than that? And why did you bootstrap it? Or did you try to venture raise and it didn't work? Or just trying to understand the original thought processes?
Yeah, actually, the mission is pretty similar. So the reason why it was called mypizza.com was because I believed that there was a brand to be built that champions the independent segment of the pizza industry. To give you some context, the industry itself is about, there's in the US alone, there's only the US, $47 billion in revenue, passes through 77,000 pizza restaurants. Only 20,000 of that is the big chains combined. The rest is fragmented independents and small chains. And so, we see what Domino's has done with their brand, Papa John's, Pizza Hut. And I felt that there was an opportunity to create a brand that ultimately champions all these amazing local authentic independents and also bring technology to the space. So I call the model a reverse franchise model. Again, going back to my franchise roots, I realized that the opportunity to bring some of those benefits to independence was going to be game changing, and so that was it. For those of you that may want to go and look at something pretty interesting, I created my own press release June of 2010. It actually still lives online. So if you search My Pizza PR Web, you're going to see that press release that I wrote, quoted myself, and it'll probably be very, very similar to what our story and our mission is today. I bootstrapped because that's all I knew. I'll be honest, I didn't really know much about the VC industry until 2016. I was raised with a very entrepreneurial mind, and I was taught to hopefully build something for $1, sell it for $2 as many times as possible. And quite interestingly, that is exactly what our model was from day one. It costs us $1 to process an order, and we charge $2 per order for the first, in fact, 8 years. We just changed the price to $2.25. But that's been our model, and I love bootstrapping. It gave me some amazing advantages. It also provided us with the opportunity to raise capital with very little dilution.
And so what changed in 2015 or 16 when you decided, okay, now's the time to raise money? Did you have a need for it? Did you see the world changing around you? Did you realize for all of a sudden the opportunity was bigger than before? Did you need to accelerate? Like, how does one change one's mindset from bootstrapping to, okay, now venture scalable businesses?
Yeah, it's an interesting story. So money was actually not our problem. We were profitable. So in 2015, the profit coming into the business bottom line was in the $250,000 per month range.
Wow.
So it was significant capital coming into the company. And, we were just not necessarily, we couldn't keep up with growth. I did get an offer to sell the company. So I got an offer of $18 million to sell my business. And I almost did it. But what I realized was that I was probably going to go and start another company. And the question I asked myself is, what if I treat this business as that new company? What would the ceiling be then? And we were growing quickly. So turned down the offer. And the first thing I did was reached out to one of the founding members of Seamless, who had already sold the company. For me, it was all about getting them on board, helping me scale the team, and giving me some guidance on how to grow faster, but also how to build a scale. And in order to get them on board, they wanted to invest. And so I took $1 million, predominantly led by that group. And that was my introduction to capital, but also what additional capital really affords an entrepreneur and how we can move faster. So that was how we went from bootstrap to venture back.
And you used that. Did you immediately go and raise venture money at the same time, or you used the $1 million to do something and then went to the VC route?
Yeah, we used the first $1 million to actually put together a foundation. I'll be honest, we didn't even have QuickBooks. We were managing 40 million in GMV through Excel spreadsheets. So we brought on a
Sounds
head of
familiar,
finance.
actually.
Yeah. So it was really doing a lot of the basics better. And then pretty quickly, I met Ben Sun from Primary Ventures, who you probably know very well.
They're in our building,
Um,
actually.
through that, yeah, and they're incredible. So within a handful of months, Ben and Primary ended up leading a more real venture round of I think it was $2.5 million, and that was in 2016.
And was that first time raising VC money? Was that easy? Was that hard? Because I can imagine a lot of VCs. You go to them and you're like, oh, I'm doing a pizza food delivery app, and I know that's not what you are, but like that's what might come in their mind. They're like, wait a minute, there's Seamless Grubhub, there's Uber Eats, there's DoorDash, there's Postmates. Why does one need a vertical? I mean, did that question come up a lot, or like how difficult was this first raise?
It actually was not difficult at all. I think the reason was because we were, again, growing quickly and we had all this revenue, we had all this GMV, and our story from the beginning has been very sort of deeply rooted in an analogy around Domino's. We believe, like if I take a step
Yeah.
back, this was my pitch to Ben. Hey, Ben, there are 55,000 local pizzerias in the US. There's 20,000 big chains. The big chains at that time are managing 60% of their volume through e-commerce. The local segment, 2%. Slice is going to take the local segment and turn it into 100. Why do we believe that's going to be the case? Because we believe the consumer eventually will be ordering through mobile no matter what. And so that was ultimately the pitch. And so here's some proof points of what we've done so far. We worked with 3,000 locations. We were doing 40 million, or at that time 50 million in GMV.
And that's when exactly, just to get a sense of timing.
So that was our A round. That was in the summer of 2016.
And you raised how much from whom?
So that was a $2.5 million round led by Primary
Okay.
Ventures. Also part of that round were Contour Ventures and River Park.
Cool. And okay, so at that point, the Domino's of the world were at 60% online ordering, and the mom and pops at 2%. Wow, that's quite the
Yes.
gap.
Correct.
It-
And there's still a major gap. Today it's somewhere around 9% for local and 75% for Domino's and Papa John's.
And so, what is it exactly you do for these mom and pop pizzerias today? Like what is the scope of work? Because perhaps I think that will illustrate why you're so fundamentally different than an Uber Eats, which basically puts the menu online, has a delivery people, and that's it. And there's nothing else they really need to do. I mean, I'm exaggerating, but it's not much of an exaggeration.
Yeah, no, it's pretty simple. We are much closer to a Shopify model than we are to a Grubhub or Uber Eats. We basically come in with software we provide a small business, a website, online ordering, CRM, marketing services. We recently, not recently anymore, but in 2017, we launched our Slice app, which is a direct-to-consumer demand gen product. Collectively, we provide that out-of-the-box solution. There's an omni-channel component, so there's Google Food Ordering, Instagram Shopping, TripAdvisor, Nextdoor. So in essence, with the flip of a switch, a local independent pizzeria gets this all-in solution that allows them to not only offer e-commerce to the customer, but Slice actually manages that transformation for them. We do the work. Fast forward to this year, in March, we launched Slice Register, which is a curated point of sale solution built for pizzerias. And then we launched Slice Rewards, which is a one of its kind rewards program that provides the customer with a free pizza for every 8 orders, regardless of where they order from within our network of 16,000 locations. So it's collectively, I call it a reverse franchise model. Basically, the way to think about it is, right now, an entrepreneur who wants to open up a pizza shop has 2 options. They can open up a Domino's and think about what they get for that. They get a proven system. They get Domino's corporate who will do the marketing for them. There's a brand. There's technology. There's a mobile app. a lot of the business solutions are already solved, and the person can focus on, running the day to day and ultimately focusing on making the food. Now,
And how much that
most
costs
entrepreneurs,
by comparison?
I mean, to launch Domino's, it costs like
Okay.
$1 million, but they also make 1.2 million a year in sales, which is awesome. And Fabrice, to your thesis, a lot of people don't choose that path because they are passionate about the craft. They want to make authentic food. That this is what they know. So they go the independent route. The independent route is independent. They don't have any access to data. They don't have any access to marketing or brand. They don't have any access to technology. And as a maker, I mean, I'm wearing a shirt that says make. As a maker, they're not qualified to solve these problems. And so Slice comes in and solves all of these business challenges the way Domino's corporate does for their franchisees. So we are this incredibly vertically focused, full stack, all-in solution that allows independent operators to be in business for themselves, not
And
by
obviously,
themselves.
you charge purely on a variable cost basis, but would the cost of launching your own mom and pop pizzeria be a lot lower with Slice, or relative to the million two, or not?
Oh no, it would be a lot lower because we now have economies of scale. So instead of an independent buying alone, they can now buy collectively as part of this group of 16,000 other owners who share so many similar qualities. So we now have lowered the cost on some equipment. We can negotiate leases. We brought forward buying power on payment processing. So we've lowered payment processing costs significantly. Cost of pizza boxes and
But the
menus and
setup cost,
bags.
would that how different would that be? Just so I get a sense of comparison.
Yeah, the setup costs right now, we're launching some locations with some partners. They're in the $250,000
Yeah, I mean,
range.
look, that's 5 to 6x lower, and many people don't have access to the capital to launch a Domino's type franchise. The
Exactly.
Yeah, I mean, what you're describing to me falls exactly in what I call my vision of the future of work, right? Like if you're Luigi and you want to make authentic pizza, you want to cook the best pizza you can, you want to interact with your customers, that's your expertise. You don't want to be like doing, picking up the phone, creating a website, getting an app up and running, doing the accounting, negotiating a POS system, negotiating supplies. And so the fact that Slice can do literally all of that, so you can do what you do best, and yet still be in a position to compete with Domino's, to me makes so much sense from a future of work perspective.
Absolutely. I mean, look, my relatives own pizzerias. They have no business advertising. They should not be spending any marketing dollars. And the wild part is that we learned last year collectively, our partners, not the whole industry, but our partners had spent more than $500 million on marketing.
Wow.
Fragmented, inefficient marketing solutions that just don't necessarily return the same value as Domino's does when they bundle those solutions and ultimately have experts running it.
But you're doing everything, including things like picking up the phone or helping with them, like pick packaging, even like picking a location, or like before they even launch a pizzeria, or not yet.
Yeah, that's our newest program we call Project Phoenix. And Project Phoenix partners with either existing great operators, because we have data, or operators who have proven the ability or have shown that they have the capacity to be a great owner. We partner with them and help them choose the right location, negotiate the lease, help them with equipment, and ultimately launch new locations. So for us, Fabrice, it's not just about partnering with the 55,000 existing locations. For us, success now is how do we scale the industry to 100,000 plus locations that are predominantly independent small business?
I mean, most of there's been a lot of complaining that like these food delivery companies take a lot, like the 30% cut or whatever. Like, how much do you charge for doing all of this?
Yeah, we have we're the first ones to create this, what I call transactional SaaS model. We charge $2.25 per order, and it's capped at that level. Also, there are no costs for orders that are below $10. There's a processing fee, which is a pass-through. And so collectively to the merchant, this is about a 6.5% fee for all of these solutions that we
So
bring
everyone
forward.
is losing money charging 30%. How could you actually not lose too much money charging 6.5%?
Well, a couple of things. One is we are a software business, software and services, but we don't provide the delivery. The beauty of the pizza industry is the vast majority of the category has their own
I see.
delivery drivers. We call it first party delivery. Two, we're okay with having a margin profile. We have a 75% gross margins. We're okay with charging less and playing the long game and making sure that the model remains a win-win model. It's very, very important that the small business actually sees incremental growth in sales and profit as a result of that digital transformation.
So in the 6.5%, you have a 75% margin, which is still really good.
Yes.
And to your point, so if someone does the digital transformation with you, on average, how much are they increasing their sales?
Oh, it's significant. So I'll give you the story of Billy's Pizza or Pizza Mia. What we're seeing is these locations are now doing $500,000 to $1 million a year on Slice alone. The average pizzeria that is predominantly offline sees about $500,000 a year in sales total.
Okay.
And so we're now increasing the TAM, or really the profile of these locations, and taking them from 500,000 a year to 800,000 a year in sales.
Is that the
But the
average, or
beauty
is that
is
an
because-
outlier, like really increasing them by that much?
No, that's what we're
Oh,
doing.
the average is going
as
from
they scale.
500,000 to 800,000. That's really extraordinary.
Yeah.
I mean, because that's
It-
max, huge increase in their underlying net income and it's transformational for the lives of these mom and pops.
It truly is, and here's the reason why. The average order value for an e-commerce order coming through Slice is about $36. For the telephone, it's about 19 or 20. Why? The consumer has the convenience of sorting and going through the full menu. The Slice product upsells the customer every single time. Slice Rewards has a minimum of $15, which results in consumers adding more items to their cart. You're doing all of this leveraging technology, but last time you called a pizza shop, I don't think that anyone on the phone is telling you about more items that you can buy.
That's true.
Two, we have a direct relationship with the consumer. The consumer is no longer offline, and therefore we can communicate to that customer in a higher frequency and ultimately influence their ordering behavior so that they come back more
So
often.
I get the value proposition for the mom and pop pizzerias. What's the consumer value proposition? Because most, again, if I go to my friend group and I explain to them, hey, I love Slice, it's the best place to get authentic pizza, they're like, yeah, but the reality is, whatever Lombardi's is on Uber Eats. Why would I download Slice? I don't need more apps on my phone. So how do you combat that? How do you get the demand side?
Yeah, we believe in an experience that is easy, accessible, and rewarding. Remember, for Slice, it's not so much about discovery. It's much more about connecting you to the local favorites and making that experience so easy and so rewarding, where you're not paying crazy fees to order from Lombardi's. So put simply, the consumer now has a choice. They can order on Slice, the channel of choice for Lombardi's, and they can buy a pizza for $16, or they can order on Uber Eats and pay $22. And maybe be third or fourth in line in the delivery because they have to deliver a McDonald's and a Chipotle on the way.
But wouldn't the difference also
It's
be geographic coverage? Like, I think you guys are way more in suburbs that may not have the Uber Eats penetration.
Oh, definitely. So the second part is over 90% of pizzerias are in suburbs and smaller towns in the country. I mean, every neighborhood has a pizza shop, and Slices across 3,100 cities and towns in some of the most rural areas where pizza is the staple of that neighborhood. So our best performing locations are in towns like Apex, North Carolina, Naugatuck, Connecticut. Vinny's Pizza, it's called. It's a small shop, but they do $1 million on Slice a year. which is kind of wild.
It sounds to me that the demand side, a lot of it is coming from converting the existing customers of the pizzeria that are coming in, or they're doing the delivery, and there's packaging that says you need to download Slice, or they're calling, and you're obviously the one managing the call center and like converting them to online, but that doesn't. It feels like it's existing customers. How do you get them from 500K to 800K? Is it like the same existing customers buy more, or do you also have like somehow new customer acquisition? Like, do you do any marketing on the demand side, or yeah?
Yeah, it's actually both. But the primary job to be done for us is to increase the LTV of the existing customers.
I see.
So by transitioning the customer from an inefficient channel like the phone to a very efficient and high growth channel like e-commerce, the consumer LTV for the existing base goes up. Secondary is new customers. So as you unlock more channels, Google food ordering, Instagram shopping, SEO, without a doubt, more customers end up finding local shops instead of a Domino's or Papa John's or Little Caesars. And then obviously we now are doing some pretty aggressive brand marketing for Slice.
You are as well.
For a lot of you that we are. So top of the funnel, TV, digital ads. We just launched Slice Rewards, so there's a lot of ads going out to communicate the Slice Rewards launch. But yeah, collectively we're focused on both.
So a long time ago, I guess, for most of your history, though, the demand side CAC was probably zero. You were acquiring the pizzeria, and then you were converting their customers to go into Slice. So that's a CAC of zero essentially on the consumer side. But now you're actually doing advertising. If you're doing TV, and we didn't discuss this, but like in my prior life, I spent like $1 billion on TV, and we ran TV almost $1 billion. The way we run Google and Facebook, meaning like CAC to LTV analysis, making sure we have attribution models. We should definitely talk where we can help you make sure that you're optimizing your TV spends, because that's something we're really, really good at. And we do it obviously for free. So we should follow up offline after this.
Let's do it. Yeah. But just keep in mind, in fact, the overwhelming majority of our customers still come in through organic channels that are zero CAC. So 90% of our consumer base comes in through zero CAC channels, whether that's SEO, omni-channel sort of unlocks and whatnot. And then about 10% is acquired with paid coming directly to the Slice app. And
pizzerias don't mind, they go to the Slice app because you're converting their existing customer, but they go to a Slice app, not an app for that specific pizzeria. They can choose that pizzeria as default if they want, but they're seeing a lot of other options. They're not worried that, you've taken that customer and now you might convert him to other pizzerias, or like, how do you address that concern?
Yeah, no, it's sometimes it's a concern, but not really, because we have a very democratic model. We don't have ad spend where pizzerias can outbid each other for placement. For us, it's all about connecting the consumer to the local favorites that they already know and love, and making that experience easy and as high frequency as possible. So there are some locations that will say, hey, look, how does this work for me? And really the ask that we have for them is, look, trust us, and as long as you see your order volume growing, that's the name of the game. How we're doing it, you just have to trust that Slice is doing it with your best interest in mind. And here's why that's important. For a pizzeria owner, they want the customer to be very loyal to them. And I understand that. But our data now, because we've processed millions and millions of orders, show very, very clearly that a consumer has 4 local favorites equally. They want to be loyal to 4 locations, not one.
Okay, that's actually interesting. If you'd asked me, my intuition would have been, I order it from the same pizzeria every Friday, so they have 4 different favorites. Okay, that makes sense.
They have 4 favorites, and we've got to reconcile that difference. And for Slice, we want to make sure that those 4 favorites are on one product, one app, because no one's going to install an individual pizzeria. Yeah. They're not going to install 4 apps.
No, that's for sure. I mean, that makes a lot of sense. So we got to 2016 or 2017, the primary round of 2.5 million, if I'm not mistaken. So what happened next? Like, where did that get you to, and how was the next fundraise?
Yeah, so the primary round was helped us really start scaling our product engineering and marketing functions, and brought on a great brand marketer in the New York ecosystem. His name is Nick Karat. At the time, he was at Plated. And Nick came on board, and first order of business was, okay, let's figure out what we're going to do about this mypizza.com brand. It's about to be 2017. We don't really have a mobile presence. We still did not have any apps. And so we used that capital to do a couple of things. One, we built best-in-class mobile apps for iOS and Android, and we rebranded, in essence, relaunched the company as Slice. And that was going into 2017. So summer of 2016, we raised this capital. By November 2016, we launched Slice, the Slice app product, and the Slice brand. And that was our entryway into the direct-to-consumer product and business. That started to really accelerate our growth even further. I think at that point, we may have been growing 200% year over year. And that's when I met GGV, Jeff Richards, who introduced us, actually, I believe. And so Jeff Richards was someone that I jumped on a call while we were at the Pizza Expo in Vegas in March of 2017. So there's this amazing thing called the International Pizza Expo in Vegas. It is a real thing. It's bonkers. It's wild. It's like the entire Las Vegas convention center, and every possible vendor that sells to a pizzeria is there. And think about 10 or 12,000 pizzeria owners show up collectively as one big community. And so we're there showcasing the Slice product. I jump on a call with Jeff Richards, share my story with him, and to Jeff's credit, and a lot of people who may work with GGV will know this, within 8 hours he was there. He jumped on a plane, came to Vegas, spent the day with us at the Pizza Expo, and ultimately led our Series B round, which was $15 million. And that was we closed it in May of 2017.
Did you run a process, or you just said, I love this guy, he's doing the right thing, you have the deal?
No, we were running a process. It was a pretty quick process. I don't even know if we had a deck. I think we had a deck, but it was a process to really help fuel that new product and the Slice launch, and ultimately scale our network of pizza restaurants. At that time, we had 3 term sheets from some best-in-class investors, Kleiner, Insight, etc. And GGV kind of came in at the tail end of the process, and they were just, in my opinion, best-in-class in terms of long-term thinking, entrepreneur. Not that the others weren't, but ultimately they won the deal.
Sure. Cool. And so you take the 15 million, and then what happens next?
Yeah. So again, this is back then when a B round was 15 million, which was a pretty decent sized B round. I think today it's maybe 5 times that. So we took the capital and poured it into scaling our sales engine. So we really started to accelerate the acquisition of merchants on the platform. And then we started to dabble in the direct-to-consumer business to scale the consumer side. And so collectively, I think we created this strategy we call land and expand, which is, okay, land as many dots on the map, as many locations as possible, and then expand our vertical sort of integration within these locations to ultimately reach more and more consumers. And so that really allowed us to accelerate faster. Ended up hiring a world-class leadership team, including Ryan Scott, who led our consumer business for a while, until recently Etsy poached him from us, and he's now the CMO at Etsy. He's done an amazing job there, but started to build out a world-class team that helped scale the business. And I kind of took a step back and got out of the way of the day-to-day, focused more on vision, strategy, and challenging ourselves to be better and stronger.
The land and expand is super common in like the B2B SaaS businesses, right? Like you sign a contract and then you start in these existing customers, selling more and more and more. And most of the best businesses have negative churn, which I assume you do too, because you start where you're like, oh, you're the marketplace. And then we're like, well, why don't we also pick up the phone? Why don't we help with packaging? Why don't we take the POS, et cetera? So I think that makes a lot of sense, and it's definitely best practice in the category. I assume you have negative revenue churn over time?
We do. I think right now it's somewhere in the 120 or 130%. And it's exactly like SaaS, but this is transactional SaaS. So the way SaaS companies grow their revenue from the same store, from the same customers, is by selling more
Yeah.
seats. So as that company grows, then they have to buy more licenses, and then therefore the revenue for that location or that customer grows. For Slice, it's the consumer. The consumer is the seat. So with each layer of integration or module that the merchant adopts, the number of consumers we get to manage grows. And because we have this SaaS-like revenue of $2 per order, it works exactly the same way. It just happens to be transactional.
And by the way, doing it that way transactionally aligns your interests more with your pizzeria customers because they grow, you grow, as opposed to you just keep jacking up whatever they're paying.
Yeah, we call it a win-win. That's our commercial. It's win-win. That's exactly how we think about it.
One of the viewers is asking, Netflix has a watch something feature to simplify choosing what to watch. The Slice of a "I'm hungry, feed me" or surprise me function to help discover great food automatically. Question from Glow Keys.
It's so interesting. Yeah, it's so interesting you bring this up. We were just talking about this with one of our board advisors who brought forward an idea which I love, and it's exactly similar to this. And I think also it fits your thesis, Fabrice, which is the marketplace selects
Marketplace
model.
pick, exactly.
And that is where marketplace picks. And so consumer comes in, Slice is now viewed as the expert in the space. So the consumer actually trusts Slice's decision on which merchant to go with if they're in the discovery mode, more so than their own sort of search, sort, filter mechanism. So we will start working on a product that will allow people. It's kind of like the "I'm feeling lucky" button, but it'll be better packaged. But it will be this marketplace selects, marketplace picks feature that will, help us give the consumer, remove this paradigm of choice and give the consumer a much faster experience.
Cool. Well, that's fantastic. I think they're looking forward to it. So you took the 15 million, you had the best-in-class iOS and Android apps, you start scaling the team, you have best-in-class, let's say, operators across the board, and you start scaling the sales team to get more and more pizzerias. And that takes you where, and what happens next?
Hey, Fabrice, I think I lost you for
I
lost you for a moment. Here we are.
Okay.
Yeah.
So repeating the question, said, so you raise the 15 million, you build the best-in-class iOS and Android, you scale the sales team, you build an amazing team, you get out of their way. So where did that get you? And so what happens next?
Yeah, so I get out of the way, and this is where some lessons now start kicking in. I feel like I got out of the way too fast, too soon, without necessarily spending enough time with our new leadership team coming in. Everything's going really fast. We're hiring like crazy, and things start getting pretty fragmented. So for the next, call it 12 months or so, while our performance continued to improve, we started burning a lot more capital. And that capital burn wasn't necessarily leading to an incremental lift in revenue and GMV. That was associated with obviously that spend. I think, leaders that came on board kind of fell back to what they knew how to do best in their own experience. So, as we've said, our strategy is vertically integrate with the merchant. That's where we primarily get access to the consumer. Instead, we ended up going direct to consumer and spending a ton of money trying to compete with Grubhub on consumer acquisition. And we know we're going to lose that game. You can't win, in that game with someone who's got the 10x scale than you do. So giving that as one example, I think for the next 12 to 14 months, there were a bunch of lessons we learned and a bunch of lessons I learned to where our execution didn't necessarily match the amount of investments we were pouring into the company. And so my next round was much, much more challenging. It was definitely a real challenge. Because we couldn't show how that additional incremental spend resulted in incremental growth.
And remind me when that was. Was that the one that we essentially kind of led at FJ Labs and I did personally, or?
That was it. That was the one. Yeah, that was the one where you and I spent some time. We walked through sort of how the business was operating. We had started to get get things under control again. I think you started to see an increase in performance
Yeah.
again, and that's where you guys jumped in, and it was GGV again who jumped in.
Yeah, I
And
think the
Teamwork
market,
Venture.
exactly, was seeing the competition head on with Grubhubs of the world, and we're like, whoa, like that can't be the way forward, or that doesn't work, and that's where like the thesis still holds. I mean, there was like just the wrong side turn for a while, but like, and I think we wrote perhaps the biggest check we've ever written any company. Like usually we write like 500K checks, and essentially we co-led or led this round, which is very unique for us.
You definitely co-led it,
Yeah.
and that's exactly the case. That's what happened because we ended up falling back into sort of this direct-to-consumer acquisition game. That put us directly in the conversation with how are you going to win that game against Grubhub, and you can't, right? And
Yeah.
so I think our conversations were pretty clear, and I think this is where your experience and thesis kind of came forward, and hopefully, well, in fact, it has
So
worked
when
out
was
really
that
well.
round, and what's happened since? So
That was in 2019.
okay.
So that was in
Okay.
2019, and what's happened since? So 2019, we do that round, allows us to then get back on track, allows us to readjust and go back to our roots, as I called it. We did a whole mission. Okay, get back to our roots, and growth started to accelerate quickly again. I mean, we were growing, but growth became much more efficient.
Organic growth that you're not paying for and that's profitable on a unit economic level makes all the difference in the world.
Exactly. Our business model is very B2B still, right? And so we went back to looking at the B2B metrics and saying, okay, are we selling these merchants into these modules instead of like this direct-to-consumer game? And so fast forward, that allowed us to really execute well. And then fast forward to March of 2020, and that is where just things changed forever. Obviously, one of the folks that I'd gotten to know for the last 4 or 5 years is Jake Heller, who was an investor at Spectrum Equity, ultimately ended up going to KKR to lead their new fund, which is venture growth. And Jake and I had a bunch of really good conversations, and he was like, dude, just keep me in mind next time you want to raise capital. So earlier in 2020, in January, he let me know that he was at KKR. He really wanted to get involved in the business, and we just kind of left it at that. March of 2020 happens. Everything kind of changes. The entire country decides to go and stay at home. And if you remember, for those first 2 weeks, it was actually everybody, including businesses. And so the performance of our business for the first 2 weeks of the pandemic just tanked because nothing was open. Everyone was at home. Everything was closed. And I called Jake and I said, Jake, actually, first conversation was with Jeff Richards. Yep. Now, for those of you that may not know, GGV's fund is split with 3 partners in the US, 3 partners in China. And Jeff had a firsthand view into what was happening in China after those first couple of weeks because their experience with COVID was a little bit ahead of the US. And Jeff was like, dude, this thing is about to accelerate greatly. I'm seeing it in China. We've got to get in a position to play offense. I called Jake and I said, Jake, now's the time. You want to jump in and put in some capital into the business. I don't want to play defense like everybody else. I want to be in a position to play offense. So to their credit, literally the day the entire market tanked, they gave us a term sheet for our Series C, which was for $43 million. And that was in March of 2020, and we closed it by end of April of 2020. And that allowed us to do exactly that. We played a lot of offense the rest of the 2020, where our growth ended up accelerating by 200%.
I mean, not surprising, right? Like everyone started ordering food online. I think there's been a step change in like online food ordering penetration, and it's true and everything. I mean, I'm sure DoorDash, Postmates, Uber Eats, etc., but also Instacart, Drizzly. I mean, Drizzly, I think 6x between February and April of 2020. I mean, like all the online food ordering businesses are definitely like
but it wasn't that obvious in
No,
March.
absolutely. When everything's
It
shut
really
down, it wasn't
was,
obvious.
yeah. And we didn't know what was going to happen. And so, yeah, that was our Series C. That was
And
43
so, what does
million.
playing offense
Um,
mean during a pandemic? Like, what did you do exactly?
oh, give away the product to merchants who are in need and say, hey, look, for the next 6 months, no fees. Just jump on board. We're going to help you stay alive. We're going to help you thrive. In fact, we created a campaign we call Can't Stop Pizza, and we literally helped thousands and thousands of locations not only stay open,
Wow.
but unlock this massive new channel to the consumer because a lot of these locations were like cash only. No one wanted to exchange cash. They couldn't accept orders online. There was no curbside pickup technology. Like, so we literally went and accelerated the adoption of Slice with merchants. Unfortunately, it was in parallel with a bunch of merchants who just completely shut down. And then on the flip side, we accelerated our investments in communicating to the consumer the option to order through e-commerce for their local pizzeria.
And so that got you where? Because if I'm not mistaken, you raised another round recently. So
Yeah, so that got us to, I mean, we ended the last year with, I think we did about 600 million in GMV. So we doubled the year. And then going into this year, that growth acceleration, the exit velocity for Q4 of 2020 was so high that we, it put us on track to do $1 billion in GMV this year. So coming into this year, again, a couple of folks that I've met along the journey, Adam Bain and Dick Costello, awesome operators. They have a fund called O1 Advisors. Really wanted to get involved in the company, and they sent me an offer to invest $10 million on a note, simply for the purpose of getting them on board. And then GGV, KKR, others just kind of found out quickly, and they put a round together for a $40 million, what we call Series D. But it was basically just primarily to get Adam and Dick into the company. And that was at they also tripled our valuation from last April.
and so what next? So you have 40 million in the bank plus the cash from before, so you probably have 60, 70 million in the bank. What's the objective for the next year, 2 years, 3 years? Are you going to raise more capital? I mean, that's independent of what the objectives are. We can talk about the objectives first.
Yeah, look, we have about 80 million in the bank. So if you think about it, we've burned about $40 million to get to 100 plus million in revenue, which is something I'm really proud of.
That's very capital efficient, right? And I think that's the beauty of the B2B2C approach.
Exactly. Our objectives are the following. We want to scale Slice Register across all of our locations. So this is the Slice-owned point-of-sale solution that brings those economies of scale of payment processing and workflow to the merchants. I want that to be consistently installed across our entire network. What that will do is now give us access to all of the data in the customer base to educate them on digital, but also give us access to, it will basically 20x the number of payments we manage. Step two will be
because instead of managing just the 300K online, you're also going to manage the 500K offline.
Exactly. And so turning that into what I call Slice Bank is a big opportunity for us, because today we process payments, we then send the check back to Luigi. Luigi goes to TD Bank, waits another 2 days. It's just a mess. So we're just going to convert ourselves into a financial institution that allows the merchant to have access to capital in real time, will allow us to reconcile payments with suppliers, will allow us to process payroll, and start solving some of the financial challenges or practices of the small business, and then provide them with access to short-term capital.
Look, to me, that makes a lot of sense. So, it continues on letting Luigi cook pizza, and you do all the stuff he doesn't like to do, which includes going to the bank, doing back office services, obtaining loans, etc. Or are you also becoming a B2B supplier to them, or are you helping them source food or is that new? Is that a vision for the future, or?
That's part of the vision as well. So one of the things we're exploring right now is the ability to have these micro distribution centers that are B2B. So think GoPuff or pizzerias. And the challenge that we'll solve is twofold. One, pizzerias pay a premium for product because they're buying independent, but also because they have nowhere to store it. Even if they want to buy in bulk, they have nowhere to put it. These are like 1,000 square locations. So if we can buy in bulk and store it and then make that accessible to the merchant in real time, where they can request supplies from the slice register, that will be
but
magic.
you might need so many dark stores to do that. That's going to be capital intensive, no?
We'll it's either going to be dark stores or it'll be a peer-to-peer network, but we'll figure that out. That's something that we think about as part of our long-term vision.
So how many pizzerias do you have right now, like in the network?
Today we work with over 16,000 locations.
And
you're
going to go to, and there's 50 or 55K to go to, basically.
There's 55K that exist in the U.S. today. That's not including international markets. But I do think the supply side is constrained by barriers to entry. And so as we remove barriers to entry, I do believe that there will be 100,000 plus small business locations in the pizza industry.
So the objective is to be in a GMV basis. So you're at $1 billion run rate more or less now. You want to be at like X billion by when, more or less? I mean,
yeah, I try not to think too far ahead, but as I've told our board for a while, I see a very clear path to $1 billion GMV, and we're there.
And that's done.
And now I see that's done. I now see a very, very clear path to 10 billion in GMV, and it's simply grounded by that land and expand model, which is, okay, let's get to 25,000 locations from 16. And instead of managing 120 orders per month per location, let's get to, 300-400 orders per month per location. And that's possible because, a Domino's does 4,000 orders per month per location online. And we have locations that already are at 500 or 1,000 orders per month. So it's just a matter of like graduating the network over to the modules that we talk about.
Yeah, I mean, look, the negative revenue churn, if you want, that we discussed earlier, signing more people, helping them sell more. Yeah, I mean, look, the numbers we did originally is like a $47 billion pizza market. In a way, you're 1 billion of that. Is there a path,
Correct,
given that independents are 2/3 of that 47 billion to 10 billion? Yeah, and can that 47 billion become bigger too? Probably, right? Like, so it seems, I mean, not easy, but definitely achievable. That's why I think it's like that the safest bet on like definitely unicorn and probably decacorn in the portfolio is probably Slice for that reason.
Appreciate that. But yeah, that's exactly how we think about it. And I do get excited about international markets as well. I know you and I have had some of those conversations, but for now, focused on the U.S. market. And one of our superpowers is this maniacal focus. The amount of times I've gotten questions about why not other restaurants? Why not international? And I think this focus ends up becoming such a superpower.
I mean, I feel the same way, frankly, across the board. I feel the same way about FJ Labs. Or focus on marketplaces is a superpower. And if you're doing whatever Mexican food, again, it's slightly different, but it's different enough that you lose that authenticity. Or if you're going to Europe, where I think it's like fundamentally different. I mean, maybe Canada eventually, that looks similar enough. But frankly, my main recommendation to founders in the US is don't go international, right? Like, it's easier for you to go from 1 billion GMV in the US to 2 billion GMV in the US than 0 to 1 anywhere else by probably a factor of 1,000. And he'll distract you from your eye on the ball. And until it might even still be true at 10 billion. How do you go from 10 billion to 20 billion? And so eventually it'll be public. If there's other slices around the world, we could buy them with our expensive currency because they'll be cheaper because it won't be American anyway. Or might not even be worth it. So I agree. I would focus. I wouldn't take my eye off the ball. Just do more in the category you're in, right? Like providing the B2B supplies to the pizzerias. Just that is by definition, probably a $30 or $40 billion opportunity on top of the $47 billion at the beginning. So you can make the category bigger.
Yeah, that's a $20 billion opportunity. So the GMV of B2B supplies is $20 billion.
Yeah, so the POS is a huge opportunity. The banking and the loans are a huge opportunity. Yeah, so you're still at the very beginning of the journey. And that's actually what's cool when you think about it. You find the thing you love, 11 years in, you're day one,
Exactly. So I really enjoy it, and I think, yeah, we're looking forward to just like focusing on execution. I try not to get distracted by things that, we'll cross the bridge when we get there in terms of how we go from 10 billion to 20. For now, there's a very clear path to 10. Let's just get that done.
Do you think you'd raise more in the future? Have you thought of going public or any of those things? Or, in the future, it might be too distracting?
Yeah, look, I think that would be in the future. Raising more capital probably is going to be something we're gonna open our minds to in the short term to be able to accelerate some things further. But we'll see. I just hired a CFO who's going to come on board in July, and that person will help us figure that out. In terms of going public, it'd be pretty cool for myself personally. I think it'd be a really good bucket list experience. But I always try to do what's best for the business. I think you look for any founder entrepreneur, taking a company public is pretty cool. But I also think it's important to realize that's the beginning of a new journey.
Absolutely.
It's a whole different.
Oh, it's not the exit. It's a financing event. It can be positive. It can increase your consumer awareness. It could maybe lower CAC on the demand side. It could allow you to attract better people or more people. But yeah, no, it's not the end of the journey. It's a continuation in the journey. And at some point it makes sense, but you need to figure out when it makes sense. So we're going to take questions from the audience, and we already have a bunch in a minute. But before we do that, is there anything we didn't cover or I didn't ask that I should have asked?
No, this was pretty awesome. It was a nice sort of journey back on the memory lane, and no, this was pretty cool. Thanks, Fabrice.
Thank you. So we have Gens Manlia from Twitch, who's asking, so going back to the bootstrap phase, what was the most difficult thing then?
The most difficult thing then, there were two difficult things. One was trying to get an owner to see the value of digital ordering, because I was passionate about it. I saw the need for it. They didn't, because they live in real time, and I was living in the future. And so how do you go to an owner and say, hey, we're going to give you online ordering, and they're like, I don't need it. How do you solve that problem? And the way we solved it was by realizing that all of these owners actually already accepted fax orders, not online orders. And we found out a way to convert online orders to fax orders.
That makes a lot of sense.
Instead of selling online ordering, we sold fax ordering.
And I can see why it might be even a generational problem. Like these owners are like in their 50s or 60s, and you're in 2010 or 2009, and you're telling them, hey, you need to take online orders. They're like, what? Why? Smartphones, they're not tech savvy. Yeah.
Exactly. And I would say the second one is, okay, fine, I'll take online orders. Who are you? I've never heard of mypizza.com. And so to solve for that, we just did like some crazy hacky things. I got 3 cars, Nissan Cubes that look like pizza boxes, literally, wrapped them with branding for My Pizza. I would park them in front of pizzerias, leave them there for a day. I would have a twin brother who would help me move them around town. And then I would go into the pizzeria and talk to them, and they would say, oh yeah, I've seen the car. And it gave us credibility when in fact it was just me.
I love the hacking, the guerrilla marketing, where it makes you look a lot bigger than you really are. Because at the end of the day, you only need to target a couple of the pizzerias. Yeah. It didn't matter that you weren't actually blanketing the entire city with cards. So you just need to be in front of the people you wanted to talk to.
Exactly. And then once we ended up getting a handful, then you can use those as case studies, and then you kind of say, hey, Luigi's on here, so hey Mario, do you want to jump on? And you get the network effects.
But funding was never an issue. Like you were just profitable from the get go, or you had enough family money, or a little bit of money saved, or.
Yeah, I sold my first franchise company. I sold it to a public company. It was for cash and stock. The stock ended up becoming worthless because of the 2009 crisis. But the cash that I had allowed me to, in essence, self-fund the business. But again, we charged from day one. It was $2 per order. It cost us $1, and we just kept doing that as much as possible.
So Pedro on LinkedIn is asking, at what point do you think of these small independent pizzerias not really being independent anymore, but being functionally powered by Slice?
Yeah, that's the thing. I believe being independent is a disadvantage in the market. And so we got to turn independence into a community. So when we say powered by Slice, we actually say it's part of the Slice family. And it's not that we want to remove the independence of their craft or how they want to run their business. We just want to remove the independence of buying alone, making decisions without data, having to figure out technology, all the things we covered.
Yeah.
So the vision is to unite local pizza, turn it into a community, and then realize those economies of scale.
Yeah, I know. The idea is not to create Slice as a Domino's alternative. Is to be the back office where we let people be their authentic selves, have their own brands, and have their own relationships. Yeah, that resonates a lot more. And I suspect in the future, as consumers are becoming more, I guess, educated and savvy, and they want these authentic experiences, that makes a lot of sense. And by the way, do you worry, speaking of that, in terms of like the mega trends, there is that trend towards like healthiness and like gluten-free and lactose-free, etc. Like that seems like anti-pizza.
No, I definitely don't worry about that because there's always room for that. Remember, our message isn't to order pizza, breakfast, lunch, and dinner. But I believe in this world where, look, there will always be a line at McDonald's. There will always be a line at a pizza shop. People will always want ice cream. It just, the beauty is it's a once a week habit, and we want to empower and amplify that habit. But no, the industry keeps growing. Okay. It's a non-issue.
Serial on LinkedIn says, if you ever envisage to sell your white label technology to launch something like this in Naples or Italy, let him know. He's game.
You got it. Yeah. Just reach out on LinkedIn.
Glow Keys on YouTube is saying, can or does Slice ever influence the individual pizzeria's menu offerings? Say, do you encourage them to offer more health-conscious food options, etc.?
Yeah, we try to democratize the data, so we try to provide feedback loops to the pizzeria owner about the quality of their food. We're actually starting to think about where there are gaps in like different types of pizzas. So, I grew up on Staten Island. Staten Island doesn't have Chicago deep dish pizza, but all the pizzerias have the ingredients necessary to make it. So we want to launch something I call Slice University that will help owners get better and become better at their craft if they want to explore selling a deep dish pizza, and Slice can say, look, we'll guarantee that we'll sell it because we see the demand. So in that sense, yes, but like actually telling them what to make, probably not, because that's the beauty of this model, is that they know the food better than we do, 10 times better than we do. And we know the technology and data and marketing 10 times better than they do. And so, as you say, Fabrice, it's about empowering them to do more of what they already know how to do well and letting that be sort of very authentic.
And what may be the last question. So it might be like asking you to choose amongst your children and tell us who the favorite is. But there's so many types of pizzas out there, right? Deep dish, thin crust, wood oven, brick oven, etc. What is your favorite?
So there's two answers to this. Whenever anyone asks you what's your favorite pizza, it's the one closest to you, because that's what we grew up with. One closest to you. And the one closest to me for as long as I grew up was Joe and Pat's Pizzeria. Incredibly thin crust. In New York City, there are two locations that are part of the same family. One is Joe and Pat's. One is Ruby Rosa, which is in Soho. So super thin crust. It's made in an oven that rotates. So it's like a deck oven, but it actually rotates to give it this baking style that is super crispy and thin. But that's my go-to. Although I'm a huge fan of Detroit style recently, which is a more fluffy, deeper dish option.
So you're New York based, and most of the firm is in New York.
Yes. We're right in Flatiron in New York City.
And if I recall, you have a big back office in Macedonia. Like, how did that happen?
We have a huge team in Macedonia. That's where I'm from. I was born there. I'm Albanian by background, but born in Macedonia. Started hiring people there because as a bootstrap company, I couldn't afford employees in New York at New York wages, but also realized that the talent there was untapped. And I'll give you an example. One of our first data entry folks was a surgeon, like a doctor, but we were able to pay them more than what the hospital was paying the doctor in Macedonia. And even at that scale, it was still 1/10 less expensive than hiring in New York. So over time, we've built a huge team there. I think today it's about 700 people. We're one of the largest
Wow.
employers in the country.
How many people work at Slice today?
We're now over 900 people at Slice,
Wow, that's
with
fantastic.
the balance being mostly in New York. Yeah.
Cool. Well, I think we've covered pretty much everything. Thank you for your time. This was wonderful, and congrats really on all the progress and on where it's going to take you in the future.
Thank you so much. Thank you, Fabrice, for having me.
Thank you, and thank you everyone for joining us today. This was fun, lots of questions, and hopefully that's helpful in your journey on a going forward basis.